All right, let's run through this options trade quickly. We have a conservative investor. We want to still be able to maximize some element of rate of return, even above what the US Treasury would, so short-term duration, risk-free investments are good. So let's break this down. First off, we have an account value of $1.65 million. What our trade is going to be is we put that whole $1.65 million into the risk-free short-term US Treasury, and then we have it two parts. We then put $932,000 on the options trade. So we have to lock that up, and then we're gonna have options contracts that are tied to that 932, and we keep 718,000 still free, just invest in the US Treasury that has no tie to the options contract. We did 106-day contracts in this example. Here's how it breaks down. So the premium that we got from that 106-day contract, all those contracts was $28,000, a little over $28,000. Now, how do we break that down into return? If we want to annualize it, the money market, say we use a money market instrument that tracks the treasuries, say that's 3.5%. And then if we were to, since it's 106 days, let's just keep it super simple and just say you do 3 of these contracts. So obviously that doesn't equal 106 times 3 doesn't equal 365, but we're just going to say in real life scenarios, you're never going to do these contracts perfect, but you could do 3 of them. So it would be fair to annualize that, which would be 12.52%. So you basically take interest plus the premium. Now you have 12.52% on the 932 and 3.5 on the 718. That gives us a blended rate of return of 8.61%. Now, the thing about options contracts, that's our ceiling. We can't get anything higher during that period of time. And now let's look at the downside. So if we want to look at downside, we can take what have we had for worst case scenarios? Let's just say a really bad scenario in a 100-day period of time would be a 40% drop in 100 days. That rarely happens, but it could happen. Worst case scenario, say we have a downside of 40%. And then what will happen is these contracts were set on an average of negative 20%. So the exposure that you have with the options is not 40%. You're only exposed about 20%. And if you have no exposure on the 718, then it doesn't matter. That 40% downturn doesn't hurt at all. So our max down is 9.19%. So if we're looking this as a trade strategy, we have this 8.61%. That's kind of capped our ceiling. And when we're in a market that has probably overvaluations, that's a pretty fair rate of return. Whereas we're not exposed. If you were fully exposed to the market, you would have a 40% drop. Like that's your exposure. So we're minimizing that drop from 40% down to only 9%. Now, if that 40% happens, there's going to be a lot of really good buys. There's going to be good companies that you can buy at a really fair price. So we can completely reassess after that 100 days on what we want to do. I just want to go through the numbers, show you where we're sitting, and give you ideas on how this contract's going to work.